The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody, and thank you for coming to this webinar. We have some very good content, and we'll get to that shortly. But let me introduce myself. My name is Soumitra Sengupta, and I am the founder of a SEBI Registered Investment Advising firm called Lamron Analysts, and we have some very interesting offerings and content for you this morning. So without much ado, let's get to the core presentation itself. I have always said, and it's not something that is very widely understood or recognized, that investments or trading or in whichever time frame that you choose to engage with the markets, the success of your efforts depends more on your internal behavioral traits rather than the objective parameters that are there in the markets. And what do I mean by objective parameters? I mean, you want to buy a company, right? You look at the PE ratio, you look at the top line growth rate, you look at um, debt equity ratio, and you draw up all the fundamental parameters of that company. Those are objective factors that are out there. What do I mean by objective? It is something that is apparent to everybody. Everybody can look at it and observe it in an objective manner. Those things are important in investments, but even more important in investments is your internal configuration, if I may use that term. I mean, how you are structured. What are your behavioral traits? So one is to understand the objective parameters, you need IQ, but I will submit to you that EQ, your emotional configuration, your emotional profile, is more important to success in investing than your IQ. In fact, many people, including Warren Buffett, have said that very mediocre IQ, even if you have very mediocre IQ, you can make millions in the markets. IQ isn't the big thing. What is the big thing is your attitude and your um, emotional profile and your understanding of what it is that is happening in the markets. So let's go to the formal presentation. In terms of the format, let's do it this way. I will have some introductory remarks. We are going to talk about behavioral traits that affect your investment decision. We'll talk about some. I'll talk about some introductory. I'll make some introductory remarks, and then we'll get to the behavioral traits that I want to talk about today. And we're going to talk about 10 such traits. 10 things that are very, very natural to us human beings. And this is not something about, so and so and this and that and so and so. It's there in all of us. It's one of the traits or fundamental aspects of being a human being, right? But those fundamental aspects of being a human being come in the way when you want to make money investing in the markets. And that is the reason why the failure rate is so high in the markets. So I will talk about those, and then we will take the questions right at the end. I think that would be better. And please send in the questions as it occurs to you, and I will take them at the end. Okay. So so let's start. As I said, we are a SEBI Registered Investment Advisory firm, and we use a lot of behavioral inputs in what we do. And I've been doing this for the last 10 to 12 years, and it is uh, an area of immense interest to me. Okay, we'll first look at some useful paradigms. What are the paradigms that function in the markets, and we have to be aligned with those paradigms. Then we'll talk about what are the behavioral flaws that can emerge, the biases that diminish your wealth. the biases that don't allow you to maximize your potential. And we'll conclude with some comments on what are the objective parameters that we can use to help ourselves. As I said, these are biases that exist in all of us, right? And what is important is that we have to become aware of them. And once we have become aware of them, we have to use techniques to protect ourselves from them. Okay. A very interesting paradigm, and these are themes, right, that are prevalent in the market. This is how the market is. And it isn't something that you would hear very often, or you wouldn't hear people talk about it. The first paradigm is that it is a loser's game. Now, what do I mean by a loser's game? And it's very, very important to remember this. Okay, what do I mean by a loser's game? Simon Remo, who's a rocket scientist, who's actually a rocket scientist, he invented the first intercontinental ballistic missiles in the United States in 1951. He was also a very good tennis player. He looked at tennis and said that, look, this is not one game. This is two games. There is the game of tennis that is played by the professionals, okay, and he called that the winner's game. And what did he mean by the winner's game? That professional tennis players have such good training and such good understanding and such athleticism, and they're physically so fit that they can only win a game by beating their opponent. I mean, they have to play so well, they have to play better than their opponent to win the game, because the standards and the levels are so high. And he called that game the winner's game. But he said there isn't one game of tennis. There are two games of tennis. The other game of tennis is the game of tennis that's played by amateurs, right? And the amateurs play what he called the loser's game. And why is this? Well, he's saying that amateurs don't have the skill sets to master that game. All aspects of their preparation is not enough. I mean, they're not athletic enough. They haven't spent that much of time in training and practicing. Their diet control. You know how professional tennis players would be these days. Every aspect of their life is monitored. So an amateur playing tennis cannot hope to win by becoming better than their opponent, because the levels, or beating the complexities of the game, because the standards are so low. So he said that the players who win the amateur games are actually winning the losers game. So what is the losers game? You have to make lesser mistakes. All you need to do is ensure that the ball goes over the net, and you wait for the other person to make the mistake, because the skill sets of the other person, your opponent, is equally inadequate, right? So the person who wins the game is the person who makes the lesser number of mistakes. And many people believe, as do I, that the markets are a loser's game. The person who wins in the stock markets is the person who makes the lesser number of mistakes. And you make the lesser number of mistakes by making the lesser number of decisions. The more decisions you take, the chances of you making mistakes goes up, right? Actually, if you look at it, life is a loser's game. I would say that people who are very happy are those who have made lesser mistakes in life, right? Okay, so that's one paradigm about the markets. It's a loser's game. It's not a winner's game. Don't go there and try to become a hero. Don't try to become Novak Djokovic, because honestly, we don't have the same amount of preparation, the athleticism, the practice, the dedication, the focus, the ambition. The second paradigm I would like to talk about is the casino, and those who have frequented casinos and are familiar with it, this will resonate with them. But like it or not, I mean, whether we phrase it in those terms or don't phrase it in those terms, the markets are a casino, right? There are winners and losers, and the outcome is uncertain, and there are certain parameters that are being played out, and those parameters result in some being favored and others being not favored. So when you are engaging with the stock markets, which is your buying and selling and all of that kind of thing, you have to keep this at the back of your mind. This doesn't mean that you ignore or forget all the good fundamental stuff that we talk about, the company analysis and all of that. Those things are all essential. But what I'm trying to say is that those things, while they are essential, is not enough. There is an X factor over and above that, which I think many of you would have experienced and will agree with, that just because you're buying a company that is looking so good in terms of its balance sheet, in terms of its business plan, growth rates, quality of its promoters, you buy the stock and then nothing happens or it goes down, and the movement of the stock doesn't really follow the script. That is the essential unpredictability of the markets. So the markets are not predictable. There is no system in the world. Nobody can do this or has done this. Even Warren Buffett has had losses, right? So you need to know that any decision that you're taking, which means buying a stock, can go wrong, right? But you have to have a method. You have to have a method which gives you what is called an edge. Like a casino never wins. So if those of you who are familiar with a roulette table will know that there are 36 pockets in a roulette board, right? But if you win, you only get 35 times the what you bet. So that one factor is always kept. That's called the house stake, right? So no matter how much you're playing, the house will always win. The casino will always win because the casino is taking away a chip of all the game that is being played. So when we engage with the markets, we have to have an edge which, while not being able to protect us at an individual stock level. So when we buy, say, 10 stocks, for sure, there would be some stocks that you would have losses on. It would be, if somebody says that I bought 10 stocks and I made money on all 10, that was a fluke, right? But while it will not protect you from profits at the individual level, um, because of your edge, it will make you profits at a macro level. So even in terms of the casino doesn't make money on every turn of the wheel, but during the whole evening while the game is being played out, at the end of the day, they usually, not even that is not a certainty, but they usually make money. Okay, so let's come to the behavioral problems that we are going to discuss today. I'd like to talk about how our nature and how our evolution, yeah, has affected our understanding of risk. So we are essentially glorified animals, right? We evolved over a period of time. Evolution trained us to develop a very good sense of physical risk, because if our ancestors did not have a good understanding of physical risk, they wouldn't have survived, and if they hadn't survived, we wouldn't have been here, right? But you didn't need an understanding of financial risk to be able to survive in the old days. So our ability to understand financial risk is not very developed, and that is one of the reasons the human brain, and there's a lot of research on this, and the human brain is not very well designed to understand financial risk. One of the biggest problems that happens when it comes to financial risk is that we give greater weightage to perceived gains than to perceived losses. So whenever we are investing in the market, I've got this nice little T diagram on the left hand side. So uh, when you look at the environment, there are two kinds of things that can happen. You can have certainty, you can have uncertainty. And then within uncertainty, you can have uncertainty that is certain and uncertainty that is uncertain. The human brain is very good at assessing situations where there's certainty. That's when we can plan. We're also good at understanding situations where the uncertainty is certain. So we can draw up a probability table, like when you're tossing a coin, right? I mean, there is whether it will be head or tail, there is a mathematical formulation for that, and we are very good at assessing those things. But we are not good at, we are hopeless, in fact, in dealing with uncertainty that is uncertain. And uncertainty that is uncertain is what happens in the stock markets. Okay, it's not only uncertain, but the level of the uncertainty is uncertain, right? But when we go into the stock market, or when we are engaging with any aspect of uncertainty, we always go in with a perception that we are going to make money. Okay, because we are essentially optimistic creatures, right? So we give much more weightage to perceived gains than to perceived losses, and that is one of the things that get us into trouble. I'll talk about prospect theory a little bit, because it has a lot of relevance to stock investing. And if people are aware of what prospect theory is, I think they would be able to deal with uncertainty in a much better way. By the way, this theory got the Nobel Prize in 2002 for the Nobel Prize for economics. And it's the full title of this theory is analysis of decision under risk. So it looked at people, and it looked at how people take decisions under conditions of risk. Okay, so here is two small little quizzes, if you like, that I put down here. Okay, you can be operating under favorable conditions. Okay, so for example, you have a choice between a sure gain of rupees 100 or a 50% chance of a gain of rupees 300, right? Now, if you go about this objectively, you will always choose the second option, 50% chance of rupees 300 gain, because the expected gain is 150 rupees, which is higher than 100. But when they did this polling, and they looked at it, 90% of the people chose the sure gain, right? 90% of the people chose sure gain. And I mean, you guys can put something down in the chat, how many of you think that this is the right answer. But mathematically, the right answer is to choose 50% of the rupees 300 gain. And this would become very clear why that is the correct answer. Is if you think about this, if you think about going, leaving a house every morning, and someone's coming and offering you this option, you say, okay, you offering me 100 rupees, I'll just take the 100 rupees and go away. The other chap is saying, no, keep tossing, or keep tossing your coin. So many days he will lose. He will not get anything. You will get your 100 rupees and go away. He's not getting anything. But over a period of time, he will make more money, right? Because when he wins, he gets 300 rupees, 3 times of what you're getting, right? So under favorable circumstances, people become risk averse. And that's a problem with the market. That's a problem with how people behave in the market. And all of us have experienced this. You guys can put down on your chat your comments about this, because this is very, very interesting. Right? And how do people become risk averse under favorable circumstances in the stock market? Sorry, anybody want to put down any comment? You can put down. But the answer is that we have this tendency to take profits too early, right? When we buy a stock and the stock moves, and the stock moves in our direction, and there is a profit, we take our profit too early, because The moment we have profits, we become risk averse, right? Which is obviously not the right thing to do. So in this game of chance that I was talking about, that is a favorable condition. And if you choose to take 100 rupees, a sheer gain of 100 rupees, you are behaving in a risk averse manner, right? ठीक है ना? So yeah, I've got a comment saying please talk in Hindi also. तो ठीक है, मैं कोशिश करूंगा हिंदी और अंग्रेजी में बात करने दोनों में. तो फेवरेबल कंडीशन जब गेन में है आप, when we are in gain we become risk averse. जैसे we take our profits too early, ठीक है, जल्दी प्रॉफिट ले लेते हैं. बहुत सारे लोग ये करते हैं. I think anyone who's familiar with the stock market, if you are um, regular in the stock market, I would be very, very surprised if you have not ever taken your profits too early. So that is that. And that is one of the major problems that people have in the market. Okay, I've got some comments here. Okay, screen में दिखाओ sir, मजा नहीं आ रहा है. I mean, I'm supposed, I have deliberately not gone into charts and all in this webinar. Maybe I'll do it the next time. But I'm just trying to talk about the concept because the charts can be very, very distracting. Then there's a comment, it happens to me every time. Vipin Kumar, I agree. It's happened to me a number of times. If we do not take profits, the stock may turn against me and hit my stop loss. Correct. But if we also take profits too early, then we are not making profits to insure us against our losses and then give us an overall profit. Because if we take 10 trades, I don't think we can expect to be profitable in all 10. We will make some losses, but the profits we make has to compensate for those losses and then still make money. Unfavorable conditions turn into hope trades, experienced loss just because of it recently. That is what I was going to come to. Now let's talk about unfavorable condition. And yes, these are real life examples that were conducted across the world, across educational profiles, across social profiles, across cultural profiles. और सभी में the answers that came was very, very similar, which shows that this is an essential part of human nature. This is how we are. And even education or income or other things which are imposed on our nature does not change it. Now, so unfavorable situation में जब when we are in an unfavorable situation, ठीक है, तो sheer loss, we have an option of a sheer loss of 100%, 100 rupees, 50% loss of 300 rupees. So in this situation, 90% of the people chose the 50% chance of loss. Again, this was the wrong answer, because in a loss situation, you have to take the loss. You have to reduce your risk and take the loss. Sheer loss is the best loss. Wall Street में एक कहावत है. I mean, there's a saying in Wall Street, your first loss is your best loss. क्योंकि I think all of us again have experienced this, that we incur a loss, then we average, then we hope, and the stock keeps falling, right? And it happens all the time. For example, say a stock like Yes Bank, I think 5-6 years ago, a lot of people lost money on that stock because they were averaging down and they were trying to buy because they thought the price was too low. I think some of that might be happening now with Adani. But in a loss situation, the rational thing to do, the correct thing is take the loss and clear your mind and get into something else. So those are the two differences between favorable conditions and unfavorable conditions, and how we as humans don't deal well with either of them. We make the mistake in favorable conditions, we make the mistake in unfavorable conditions as well. This is the prospect theory. It is a very famous theory. It got the Nobel Prize in 2002. And हमारा psychological problems क्या होता है while dealing with uncertainty, it highlighted those aspects of it. So it's not a question of P ratio अच्छा है or price to book value is good, growth is going, it's in a good sector. That is important, but that is not sufficient. How you are dealing with your risk, your gain loss configuration is important. So let me see if there are any other comments that have come. So there is the, let me see. Unfavorable conditions turned into hope trades, experienced loss just because of it recently. Vikram, why? Yeah, correct. I mean, a lot of us have. Which is the time to operate intraday trading? Usually when stocks are rising, we tend to not increase position size. When stocks are down, we don't cut the losses in anticipation of moving up, right? And in both sides, it's a mistake, right? I mean, when you are losing, there is a tendency to average because you think that you're bringing down your cost of entry and all that, but no, your total overall loss is still the same. Once downward averaging done of 5% value of stock above 5, then sell at lower margin. Oh, there are many techniques that can be done, but by and large, I don't know. Many of you may know this, but many of you might not be knowing this. 90% of people who do intraday trading lose money. 95% probably. I think Nitin Kamath had come. He had tweeted. He's the owner of Zerodha, and Zerodha can see all those trades coming through their system. And he had given this as a, they had studied the flow in their system, and they said about 90% of the traders in intraday trading lose money. And this happens all over the world. It's nothing to do with India. Okay, so if you are doing intraday trading, then you have to be able to explain to yourself why you think you are in the top 10% of India. Okay, we ourselves at Lamron Analysts, we do long-term positional trading, right? We look at long-term trends and we invest in them. So that's what we do, and we use a lot of this behavioral paradigm to avoid making mistakes. Behavioral paradigms are nothing; they are hallmarks that allow you to avoid making mistakes. Sir, I have a capital of 11,000. Should I go for intraday trading to use 5x leverage? Mr. Harsh Singhal, I don't know. I mean, my sense is if I were to do that, I would probably lose my money in 2 days. I don't know about you, but I would lose money in 2 days. Okay, I guess this is where we post our comments. Fantastic example of theory in action. I believe a lack of trading plan makes us react minded. Very true, Mr. Manish Mahanti, because of the pressure that is coming into your markets when you're looking at those prices in the screen or wherever you're looking at it, your mind stops functioning. Trust me, your mind stops functioning and you're just reacting. And reacting is not the way to make money in the markets. You're just making money for the brokers. Okay, I have experienced this in Yes Bank. Mr. Deshpande, yes, we've all done. Lot of people I know, and I know very educated people who made this mistake. I know a person whose rank was 7th in CA final. Finance director of a company made the same mistake. So that's what I was saying. The objective parameters are important, but they are not sufficient. What is important is our ability to recognize the behavioral flaws that we have. And only if we recognize it can we correct it, right? So in the case of Yes Bank, what was the problem? The problem was, and I'll come to that later, it's called anchoring effect. So even if when you go to a shop, right, and this is a very common technique, and there'll be some item over there वहाँ पे लिखा रहेगा 1,000 रुपया now slash अभी 700 रुपया में मिल रहा है 700 rupees, and you think it's a good bargain, but what is happening is that they first give you 1,000 rupees. That creates an anchor in your mind. Your brain stands focused on the 1,000, and then you say अरे अभी 700 रुपया में मिल रहा है. So, and you buy it. Same thing with Yes Bank. Oh, this stock was 700 rupees. Now it's 200 rupees. Never do that in the stock markets. Never do it in the stock markets. Okay. If you are confident of script, then only take out profits, keeping principal as it is, and add more, correct, and profit you collect, etc., etc. Jayesh Nandurkar, yeah, correct. How to define profits? I mean, at some point of time, we have to book and take money home. Until when is it too early? It depends on what your trading plan is and what your trading duration and profile is. I will talk about it a bit of what we do a little later, but I was just reading on the questions. Also in theory, I understand this very well, but how important it is to have defined losses. But in practice, I always become impulsive, right? Mr. Mishra, yes, all of us do, and you have to work very hard to discipline yourself. Can I go for silver or gold swing trading using leverage? I mean, we are not giving any recommendations here, and I don't know much about gold and silver anyway. So let's get back to the this thing. We've done a lot of taking the questions. Let's go back to the PPT itself, right? The presentation. So I will talk about 10 behavioral biases that affect us, and these affect us in terms of hampering our ability to make profits. Okay, I'm starting with number 10 and going up to number 1 because we'll talk about the important ones, but we'll talk about the red signal ones right towards the end. Number 10 is incentive cost bias, and the best example I could find of that is the IPO pricing, right? So in the IPO pricing, there are a lot of people who are involved in that pricing process. The promoter is there, the company is there, the investment bank is there, the exchange is there, yeah, the brokers are there, the distributors are there, right? But you must know, right? I mean, you must know, right, that everyone has an incentive to keep the price high because their commissions, their income is based on what is the price at which the IPO is happening, right? So don't ever think that the IPO price that is coming, and even though it may be certified by A, B, C, auditor ने किया है, इसने किया है, investment banker ने किया है, exchange ने किया है, everybody is biased and everybody has an interest in it, right? So it is not done objectively. IPO price is not done objectively. Okay, and some of the recent IPOs that we had, I think last year, and then what happened subsequent to that, I mean Zomato and all of that. So I think that clearly illustrates what I'm talking about. IPOs also tend to cause bubbles, okay, because the incentive process is wrong. So that is our number 10. Okay, the second bias is the hindsight bias, and again we all suffer from all this, right? I suffer from all this. I mean, इसमें ऐसा नहीं कि मैं आके अब सैटरडे मॉर्निंग में ज्ञान दे रहा हूँ, ये सब प्रॉब्लम्स मेरे में भी है, but what I try to do is I try to become aware of it. So then once एक बार I become aware of it, then I am able to address it. Maybe I'm not able to address it successfully, but at least I try. Okay. Hindsight bias is, and you'll see this with the television commentators all the time, right? If you follow them. At 9:15, when the market starts, they actually don't know what they're talking about. They have no idea what's going to happen to the market, right? Nobody knows what's going to happen to the market because the whole process is so complex, right? We discussed that in the loser's game, right? The process is so complex that don't try to beat it, right? But when it comes to 3:30, at the end of the market, you see the commentary that they give, as if they knew everything that happened. They will explain it to you to the last degree कि ये है, ये इसलिए हुआ था, ये उसलिए हुआ था, ये. Again, half of that is they don't know what they're talking about, right? Because if they knew what they're talking about, they could have said that at 9:15. Okay. Now, when in hindsight we think we have explained what has happened, we are being deluded. We are deluding ourselves. We are fooling ourselves into thinking that we can predict. हमको control है इसमें, but कुछ नहीं. Okay, we are as clueless at 9:15 as we were at 3:30, right? and everything that happened because of very complex processes about which we can only have a very um, thin idea. Okay, neglect of probability, and this can be turned into a question, right? Okay, so I picked up the statistics. Probability of a death in a car crash is 17.4 per 1 lakh people. Probability of death in a plane crash is 0.01 per 1 lakh people. So the probability of death in a car crash is much higher, exponentially higher than the probability of death in a plane crash. Yet when we get into the car, I don't think we are thinking, "Arey, ye car crash hone se kya hoga?" But I think many of us, not every time, but sometimes when we got onto a plane, I certainly do, we think, "Arey, what if there's a crash?" And certainly if the plane is flying and there's some turbulence, we think there's going to be a crash. But our chance of dying in a plane crash is far less than dying in a car crash, right? This is what is called neglect of probability. Our brains react emotionally to things. It is not being rational, right? It is not looking at numbers. And even though we think of ourselves as rational people, we are not in many ways. Similarly, if you're given an option, this is a good one. If you're given an option of paying, say, 10 rupees to buy a lottery ticket that will give you 1 crore in winnings, and a lottery ticket that will give you 25 lakhs in winnings, but you know that the chance of winning 1 crore is only 1%, and the chances of winning the sorry the chances of winning 25 lakhs is 25%, 5 lakhs is 25%. People would still go for the 1 crore ticket, because it just feels better, right? But your chance of winning the 5 lakhs is far higher. So rationally, you should have taken the 5 lakh bet. Instead, you take the 1 crore bet. So we have no intuitive grasp of risk. We can't intuitively understand it. I mean, we understand other things, physical things we understand. This is hot, this is cold, that we don't have to think about it. We just understand it. Risk we don't, right? So what happens? We take cues on past events. Like I have heard a lot of people say, in the light of the Yes Bank thing, that, oh my God, I mean, this bank is too risky, that bank is too risky. And we are only saying that because in the recent past, one bank went down. Okay. But in the last 20 years, only 2 banks have gone down. So probability is pretty low, right? But because this was a big failure and a lot of people lost a lot of money, this is in our minds, and we are biased and we are taking decisions based on that. The other thing about emotional intensity that happens is that, the celebrity endorsement, this, that, I mean, Shah Rukh Khan endorsing this, that, and the other, and we all know, right? I mean, he doesn't even know what the product is. He won't be able to pronounce the name of the product. Yeah, but because he's giving an endorsement, it sells, and that's why people do it. So that's the problem with decision making, right? Behavioral bias, neglect of probability. Restraint bias. Somebody had said in the comment that I couldn't control myself, right? So restraint bias is our ability or our perception that we have more restraint, we have more control over ourselves than we actually have, right? We always think, "नहीं, हम तो मतलब I am sorted, I am in control," right? We always think that we are in control, okay, but in very little aspects are we in control, right? So we overestimate our level of control, but we have very impulsive behavior, and that sometimes comes into play in the stock markets, and it can uh, cause us a lot of damage, right? Um, what can we do? Adopt a data-driven analytical approach to improve willpower, and we'll talk about that towards the end. That's what we do for a living. Okay, data-driven analytical powers. That's what we do for a living. We do our selection of stocks, portfolios, etc., based on that. But we'll come there. Smoking, junk food, all of this. Yeah, we have a restraint bias. This one also, I don't think, requires too much of explanation. We are all aware of it. Bandwagon effect. That is what causes bubbles. That is what caused those IPOs, Zomato and Paytm and all that. It usually happens in the last stages of a bull market. People who have been in the market for a longer period of time will remember from 10 years ago RMRL and those kind of stocks, the infra stocks. Again, why does this happen? Because we as human beings have a psychological and a sociological reason to be a part of our community. Very few of us can stand aside and say that we are different, right? So when the janta is doing something, we have a impulse to do it with the janta, right? And that causes a lot of problems in the stock market. Because we get sucked into bubbles and so on. So what are the implications of this? And how can we avoid this? Thinking critically, thinking independently, being able to stay away from the crowd. I mean, I'm sure all of you have heard of these contrarian calls, Warren Buffett. I mean, buy be greedy when everybody is fearful, be fearful when everybody is greedy. That is, you are thinking differently. Also, your sources of information has to be credible. Television is not a credible source of information. And there's a lot of talk these days about influencers, YouTube and all that. That is not credible either. And don't make too many decisions. Make decisions very, very in a very, very concerted manner. So let's see if there are any other questions that have come in. Let me just see. Just a minute. We are halfway through our behavioral biases, but the fun ones are yet to come. The big ones are yet to come. Let me see. There is Mr. Kirit Gada. What is the proper exit time for a stock? I mean, there isn't a fixed formula. There is no formula for this. It's a combination of judgment. It's a combination of how the company is doing. I mean, if you're doing it fundamentally, how the company is doing, what is the growth rate? Is the growth rate slackening and all of that? But there is no formula for this. People who do quantitative trading, right, systematic quantitative trading, like we do, we have certain parameters which are defined in terms of quantitative measures, which helps us to exit. But does that mean that we get it right all the time? No, we don't get it right all the time. But in the stock markets, you don't need to get it right all the time. If you get it right, actually, if you get it right 51% of the time, that's good enough. Okay. So the answer is that there is no one single formula, because if there was one single formula, everyone would use that single formula and it would stop working. If everybody is doing the same thing, it doesn't work in the stock markets. Remember that. How to check temptation of booking profit too early where there is an equal chance of stock may go down? Well, if you think that there is a equal chance of stock may go down, then taking profit is probably justified. But what I was talking about was taking profit just from an emotional point of view. That you are just looking at the. I'll give you an example from recent history, right? Those of you who are in it, you might be knowing that defense stocks have been doing very well, right? And some of those stocks I have behaved. I mean, I've seen this very, very rarely in my career, right? It's 10, 12 years. I mean, there are mid-cap stocks that have gone up 4x in 4 months. Public sector stocks, right? And we were fortunate enough to recommend some of the stocks in March to our advisory clients, and very few of them have been able to keep it. The moment it becomes 30%, they get out. 40%, they get out. Okay, so you got out at 40% in a stock that has become a four-bagger, 400% in 3 months or 4 months, right? So that is the problem with having an emotional response to profits, right? Because you will look at the profit and you will start thinking about your next holiday, or you're actually converting that money into something that is palpable in your life, your next holiday or your next car or your next whatever, and then the problems start. I mean, as long as the profit is unrealized, you should not start imagining too many things. It's like a sport, it's like a game, right? I mean, and then take it when you need to. Mr. Girish Vige, in intraday, how much percentage of profit is a good profit? I assume that 3% of the Mr. Vige, I've never done intraday trading in my life, and the only thing I know about intraday trading is what I shared a little while ago, that 90% of the people lose money. So I don't think I'll be able to help you with that. Will we get PDF download of these 10 biases? I think they do give a recording of it. If you want the biases, I will leave my email address at the end of it. You can just send a message and we'll have it delivered to you. During the swing trade duration, 2 weeks, 6 months, what should be the approach, whether to book the profit and keep the investment as it is, or keep the profit as it is and take out the investment? No, in a swing trade, if you're going to do a 6 month or a 2 week to 6 month swing trade, I mean, if your objectives have been reached, then you should take the whole thing out of the table, because it's a swing trade. It's a swing trade, not for the profits. It's a swing trade for the whole trade, right? So you should take it out, right? What we normally do in terms of advisory on swing trades is, we in addition to price stops, we also have a time stop, right? I mean, you should not carry it. I mean, a swing trade is not a long-term trade, so let's just keep the boxes separate. Okay, next is Mr. Harsh Singhal, sir. What to look for to find if the IPO will be worth investing? Look, I mean, the retail, for us retail people, the chances of winning in an IPO game is very mixed, right? But what you should I don't know what you should look for. It would change from, it is contextual. It would differ from IPO to IPO. But I can tell you what to avoid. Avoid any IPO over which there is a hype. There's a lot of press. Everybody's talking about it. That is a bubble. Right? And you must be recognizing that is what happened with the ones that I mentioned, right? Zomato, Nykaa, and all of that. And it happens. This thing happens once every 3 years. The same story happens, right? People get sucked in, then they will go and they will go to Tirupati, they will do Mundan. I'll never invest in IPOs, but 2 years later they come back and do the same thing again. Right? Actually, that's a real life example I gave. A friend of mine went to Tirupati, Mundan, never in IPOs. 2 years later went back and did it. Can we get the recording, please? I'm sure you can. That'll be there. Line. That's Mr. Suresh Sharma. Line chart better than candle pattern? Okay, I'll tell you what my answer to, or what my take to this is. Okay, that the markets are a bit like how should I put it? I mean, there are many paths to heaven, right? I mean, there isn't any one correct method in the markets. Okay, it's a very democratic place. You can use many methods to get to your goal, right? And many things work, right? I can talk about some things that definitely don't work. I'm prepared to put it down in a notarized piece of paper, in an affidavit, and have it notarized in the High Court of Bombay, right? Averaging doesn't work. Averaging on a losing trade doesn't work. Okay, but I can think of very few things that I can say with such confidence doesn't work, right? So many things work. The point about which one will you choose, it's a bit like we have this concept. Some of you would probably be familiar with it. That you have to choose the method that suits you. Every method does not suit everybody, right? So Mr. Suresh Sharma, you look at line chart and you look at candle patterns. You have to get somewhat familiar with it, and just choose the one that you are more comfortable with, because all of them work equally well or equally badly. There is no hierarchy. See, in the markets, there is no secret formula. Because if there was a secret formula and people had found it out, the secret formula would stop working. Okay? So, Mr. Sharma, the best thing is to go with your own judgment on it, right? In the markets, it's very, very important to go with your own judgment, because just keeping listening to others, anyway, most of the time they have a vested interest, others. And by thinking for yourself, you actually eliminate your risks quite a bit. Mr. Naukutkar, I have stopped investing in banks since Yes Bank chaos. That much effect it had and still has. But you see, I hope you understand. I hope I've been able to explain to you that it is a bias, because Yes Bank happened about 4-5 years ago, but in the last 20 years, only two banks have happened: Global Trust and Global Trust. I don't think people lost that kind of money. So that is a neglect of probability that I talked about. And not only you, sir. I mean, a lot of people suffer from this. Mr. Shanbag, I have started making profits in longer term positional trades. Earlier, I made some money in day trading, but day trading profits have not been sustainable for me. So I have stopped day trading and totally. So taking lesson, number of decisions has definitely helped. Of course, I mean, long term position, there is only one way. All the people who made big money in the stock markets, including Mr. Rakesh Jhunjhunwala, including Mr. Warren Buffett. Mr. Rakesh Jhunjhunwala made some 20-25% of all the money he made in only one stock. I mean, and if you are somebody can probably help me and put it down in the question about which stock. It was Titan, right? So you have to be long term to make real money in the market. The rest is all, chai ka kharcha milega. Chai, pani, do dosa, one idli, finish. Mr. Girish Vige, okay. Mr. Mohammed Taisin, hi. Nitin Ladake, what is tulip mania? Mr. Lakade. Tulip mania is the first major financial bubble that has been recorded in history. It happened in Holland, in Amsterdam, in the year around 1640. That is more than 400 years ago. And you can look it up in Google. There'll be a lot of stuff. I'll just keep it very, very short. And basically, tulip is a flower. There was a mania in flowers. Can you believe it? Perishable commodities, flowers, and it's difficult for us to understand it. And in those days, Amsterdam was the capital of the world. Amsterdam was the financial capital of the world. Holland is the country that first invented the central bank. Holland is the country that first invented the stock exchange. Holland is the country that first invented the joint stock company. In fact, there was a Dutch East India Company that was created around that time, Tulip Mania. The British East India Company that came and colonized India was a copy of the Dutch East India Company, right? So Holland in the 1600s was a very, very sophisticated place, right? The most sophisticated place in the world. Yet they were buying flowers for more than the price of gold. Okay, and then it all collapsed. It's a very, very interesting story. I would recommend to everybody who's in this program. You should read up that story. It's there in Google. Mr. Mo, kindly send me PDF and recording. If you want a PDF, Mr. Mohammed Tesin, you can. I will leave our contact details. You can just send us an email. We'll send it to you. Sir, what does oversubscribe and undersubscribe mean? Oversubscribe means that the number of people who applied for a stock is more than the number of stocks available. Undersubscribed is less. Do you believe that PSU stocks are worth buying even after the phenomenal? Mr. Chakravarti, we are not giving recommendations here. We are not allowed to actually. But they have done well this year. Not only PSU banks, all public sector has done well this year. You can get in touch with us separately if you need specific advice. If investment makes more money or swing, long-term investment always makes more money. Titan, yes, Mr. Sailesh Kumar, right. Mr. Jhunjhunwala made most of his money in Titan. In fact, he made about 20% of his money in Titan. The procedure I follow, Mr. Kaura, divide the stocks in swing and long-term, trade between 2-3 p.m. based on fundamentals, followed by technical. Again, like I said, I'm sure if it's working for you, it's working for you. Who am I to comment on it? Sounds sensible to divide it into two different strategies. I think that's fine. Can average down method be a good idea for trading in ETF? Average down method is a bad idea for anything. Like I said, Mr. Shubhranil Mitro, like I said, there are only very few things that I believe don't work in the market. Averaging doesn't. It just makes you feel good. That's all. It's an emotional response. increases the dopamine level in your brains. Do you think SEBI needs to take steps about stock market education? Yes, of course, of course, of course. That's a big point. Especially they're doing something because of influencers and all of those guys. Um, a lot of that is, if any of you have followed it, then you would know a lot of that is not good. Jayesh Nodkar, don't forget to mention your email address for PPT and PDF. I will at the end of the day. In today's times, what would be the sign of market bubble in Indian stock market? The most common cycle is, the most common indicator is P ratios, number one, very high P ratios. Then participation in the markets, volumes going up, all of those kind of. A lot of press, everybody's talking about it. सब जगह में hype है, sign of a bubble, right? Okay, so let's go to the best five, right? These are the best five. The ones we did right now were, okay, bias number 5, oversimplification, right? As I said, the markets are a very complex place. It's not possible for us to understand all the complex workings of the market, right? And therefore, we have to oversimplify. We have to rely on indicators. So all these ratios we talk about, price earning ratio and all of that, these are indicators that we have created to help us understand or cope with the complexity that is there, a complexity that is there in the entire operations of a company. The index, the Nifty index, the Sensex, what are these? These are heuristics, it's called heuristics, which allows us to get an idea of the market. Suppose tomorrow, Nifty, all these indices stop publishing, would we have any sense of how the market has done? Some koi stock ऊपर गया, कोई stock नीचे गया, हमको क्या पता कैसे गया? Okay, so these indices were created to help us understand the patterns of the market. Now, all that is good. But what we do is we tend to oversimplify from them. Okay, then we tend to see that अरे इतना ही तो हो जाएगा, बाकी we don't need to understand anything else. So we tend to put ourselves in a very narrow box, and we are not ready for unanticipated issues. Our understanding remains imperfect, and we as human beings, again, our thinking is linear. It always goes in a straight line. See, a company's profit, if a company's profit is going in a straight line for over 5 years, it's being doctored, it's being fudged. That's not how the real world is. The real world goes up and down, up and down, up and down. But we can't think in those terms. We always think, 30% growth. Chalo, just keep adding it. Even the most sophisticated programming or promotional or financial models that you will be taught in the Indian Institutes of Management are all linear. But the real world is not linear. So we have to be aware of that even the most sophisticated estimates that we are receiving are imperfect. Okay, that's oversimplification. Information bias, a favorite of mine. You see, there are many things that are happening for which we don't get information, and we will never get information. Say, for example, so we are looking at a company, we are doing all the financial analysis of the company, but this charismatic promoter, the charismatic CEO of that company, जिसने ये कंपनी को बनाया है, 30 साल तक से पाला है इस कंपनी को, right? He's the darling of the media, he's the darling of the markets, but he has terminal cancer and he's going to die in 4 months. This is the information that we will never have, right? But it is very relevant information. I'm just giving an example. There are many such kinds of information that we will never get access to. So our information that and no matter how much research you do, and no matter how much time you spend doing that research, the information that you will have will be imperfect, right? And will be inadequate, but we don't recognize that. Okay. Next is anchoring bias. I think we talked about anchoring bias, right? Yes, Bank, very good example of anchoring bias. अरे 700 रुपया में मिल रहा था, अभी 150 रुपया में मिल रहा है, ले लो. Ultimately, it went to 10, right? Again, these kind of things, there is no simple solution. We just have to be aware that we are prone to this kind of behavior. Confirmation bias. This is fantastic, and this is something that I think we are all experiencing these days. We're experiencing it in all fields, not only financial fields, in politics, in social listening. We only take in information that is confirming our bias. We have starting biases, right? Suppose, for example, somebody has a bias that large cap IT companies in India, and if you guys have been following it, there's been a divergence between the performance of the large cap ITs and the mid cap ITs companies in India. I think the big IT companies has done nothing for the last 2 years, and I'm sure a lot of people are very frustrated having bought those stocks. Now, if we now take a view that ये बड़े IT company का सब हो गया, जितना होना था हो गया, अब कुछ नहीं होने वाला है. We're taking a view, that's a bias, right? We will only read things, or we will only, in our search on the social media, we will only go towards news stories and news items that confirm our views because it makes us feel good, right? Behavioral bias is all about making us feel good because it's an emotional thing, right? We are always looking for ways in which to feel good, right? So confirmation bias is very, very dangerous, because if you bought a company based on some wrong assumptions and the company stocks are going down, and I'm sure this is again something many of us have experienced, if not all of us have experienced, we then keep searching for good news for the company, but the stock is falling 5% every day, but we're still searching. अरे इसने ये बोला, उसने वो बोला, अरे पता नहीं वो ये television channel में इसने ये बताया था. All of that is noise, right? What is factual is the price, right? Bhav Bhagwan che. That's it. So we need to be aware of confirmation bias. We need to be aware that we are not victim to it. Loss aversion, the mother of all biases. And I often tell my clients, if you can't take loss trades, don't be in the stock market. It is absurd to believe that, like I said, if you buy 10 stocks, all 10 stocks will make profits. That is a sign of lunacy. Pagal ho gaye. At best, 6 banayega profit, 4 nahi hoga. Another thing that, and maybe we'll do another webinar on that later. You see, the return profile of stock market is very, very asymmetrical. What do I mean by that? If you take the Nifty returns for any one particular year and you delve down into it, वो 50 stock में से कौन सा stock कितना, how much did it contribute to these returns? Two, three stocks account for the entire return from Nifty. The rest, 47, 46 are time pass हो रहा है. ठीक है? It's very, very skewed, right? Okay, so stocks are skewed, right? Then the stocks that did well, the returns are skewed in terms of 2 महीने में हो गया था वो, बाकी 10 महीना कुछ नहीं हुआ. Even a stock that has done well. So the stock market performance is very asymmetrical, but our minds are designed to like symmetry, right? Human beings, and that's why we are good artists and architects and all of that, because the human mind reacts very, very favorably to symmetry. And those of you who do advanced technicals, I mean, there must be many of you who are familiar with something called the Fibonacci ratio, the Fibonacci series, right? Fibonacci ratio is so popular because there is a symmetry. I mean, there have been experiments that have been done where Fibonacci ratios can be used for architecture, for construction, a lot of things, where say a furniture designed in terms of Fibonacci ratio and a set of furniture designed randomly, the one that is Fibonacci ratio immediately appeals to people because we like symmetry. But the markets are not symmetrical. That's another reason why we have problems with the market, right? And the best way to deal with this asymmetry is to be able to take your losses and all of that. And we can do another webinar later on the asymmetry of the markets, because that's very, very important. I mean, most of the time the market is doing nothing. Okay, but yet we get involved with all of that. So this is the bias. What we do to overcome behavioral biases is we have a systematic approach. So the basis of investment is rule-based, outcome is consistent, risk is based on programming, which are maintained in analytical ability instead of doing it in a emotional way. Okay, what are the things that we can do to eliminate these biases? Knowledge, of course. The value investing expert Benjamin Graham, I'm sure you've heard of it. Like I was mentioning earlier in the context of Mr. Warren Buffett, said that it does not require stratospheric IQ, business sense, all of that kind of stuff to invest. What's needed is a sound intellectual framework for making decisions and ability to keep emotions from corroding the framework. That's it, right? You have to be sensible. You don't have to be intelligent. In other words, you have to have a high EQ, not a high IQ, right? Knowledge is important. You need to understand what are the different flaws and biases. And we get so caught up in doing technicals and EA and O and 50 DMA and 200 DMA and all that. What's up, what's up, and nobody's saying that there is you should not do all of that. But you have to be aware of the fact that you may not be able to implement those things properly because of your biases. Critical thinking is very, very important. Diversification. Don't do only one thing, do various things. I cannot overemphasize the fourth point, think long term to build wealth. The markets are a death trap, right? They're just there to trap you, right? So the best way to avoid that is to think long term. A client of mine recently had called me up and he said that अरे अरे यार बहुत लॉस हो गया क्यों what were you doing? अरे नहीं इसने ब्रोकर ने मेरे को बताया कि इंट्राडे ट्रेड करो ठीक है तो what were you doing? अरे I lost about 10 lakhs. अच्छा what were you doing? इंट्राडे आप कितने डिसीजन लेते थे दिन में? 4-5 तो हो ही जाता था. अच्छा हम बोले कि एक दिन में 4-5 डिसीजन आप ले रहे हैं अंडर अ pressurized environment. It's like being in a pressure cooker, right? You're sitting inside a pressure cooker and taking 5 decisions a day, right? तो मैं उनसे पूछा कि how good do you think you are? If you're taking 5 decisions every day, how many correct decisions do you think you can take? I mean, what is your own assessment of how good you are? And that's when he understood. It's a loser's game. You need to minimize the number of mistakes you made, and minimizing the number of mistakes you make comes from minimizing the number of decisions you take. That's where long-term helps. One of the ways in which long-term helps. And engage with peers, participate in companies, keep talking to people, especially talk to people who have a different point of view, because that's when you will not fall into this trap of confirmation bias and all of those things, right? Just a minute. Yeah. Okay. So these are some of our products that we have. I'm leaving this on the screen for some time. These are the contact details, our info, our email, our mobile, and this is our login website. Okay. So I'll just take a few questions and I'll end this after that. Mr. Chandrasekhar, could you share the presentation? Yes, just write to us and we'll send it to you. Mr. Agarwal, is smart money always smart, or do they also take? Of course, they take probabilistic. Oh, it's not a 100% game. It's not a 100% game. George Soros, if you've heard of George Soros, the guy who was behind Hindenburg, by the way, multi-billionaire, made all his money from the market. I read in one of his books, 55% of his trades are right. Okay. Uh, okay, Mr. Deepak Kothari, Mr. Atul Tiwari, how to difference between optimistic zone info. That comes from judgment. So now are we in a bubble, Mr. Raju Venkat? I don't know. I don't think so. It was a nice talk. Thanks a lot, Mr. Jayesh Nakutkar. Yes, thank you very much. I think we have to end. I'm under pressure to end it. I've given you all the details. So please, if you want the presentation or whatever, get in touch with us. And thank you very much for coming. I definitely enjoyed this presentation. The organizers are telling me to stop, but if you want me to talk about biases, I can talk the whole day. Okay. And thank you very much. Goodbye.